Hello, everyone, and welcome to CREtech Talks, Perspectives in a Time of Uncertainty. I'm Ash Gonzandia, Chief Intelligence Officer at CREtech. CREtech Talks is a new virtual weekly webinar featuring the most influential leaders in real estate tech in the built world. Today, we will hear from three of the most insightful and active venture investors in the real estate tech sector as they discuss their perspectives on the impact of the pandemic on our industry at large. From accelerators to early and late stage investors, our three expert panelists will share their views on the impact of the pandemic, as well as offer tips and suggestions for startups to help them navigate these uncharted waters. It's my pleasure to introduce today's moderator, Steve Weikal. Steve is a thought leader in the future of technology, innovation, and commercial real estate, and he is the head of industry relations at MIT Center for Real Estate. Without further ado, please welcome Steve Weikal. Steve, this digital stage is yours.
Great. Thank you, Ash. And thanks for everybody out there for joining us today for this conversation. I'm delighted to have such a group of experts together to get caught up on what's going on out there. A lot is happening. Let me introduce who we've got with us. Jeff Berman, who's a general partner at Camber Creek. For those of you who don't know Camber Creek, they fund operating technology companies in construction, property management, development, and leasing. They've got 22 plus companies in the portfolio. Importantly, their investors own and operate and manage over 50 million square feet of real estate in the US. So gives them-
Oh, way more than that.
Way more than that? Okay. 150.
Close to $1 billion.
$1 billion. Okay, we got to update your LinkedIn page. Anyway, so $1 billion, I'm corrected, 1 billion square feet. So Jeff has a unique perspective on this. Then also we've got Andrew Ackerman, who's the managing director of DreamIt. And DreamIt is an early stage accelerator program and a venture fund. And they build tech products in healthcare, real estate, built environment, and security. They've accelerated more than 320 startups. Andrew, did I get that right? 320 plus?
Yeah. I'd have to go back and do the math. I just keep it over 300. It's been that way for a while.
It's a lot. So Andrew here, thanks for joining us, Andrew. And then KP Reddy, who's the founder of Shadow Ventures and also has had quite an illustrious, well-known career in startups and funding. Shadow is a seed fund investor. They have an accelerator. They do corporate VC advisory. They have 65 plus companies in the portfolio, and they are active in 25 cities, 6 countries, 3 continents. KP, did I get the data points right on that? Hope I did. KP's going to join us. So anyway, glad to have all of you here. So let's begin. There's a lot going on out in the world right now. As we were discussing a bit earlier, maybe it's too soon to make any conclusions, but let's begin by putting this in context. How does this COVID-19 situation compare to earlier cycles where we've had crises, 94, 2001, and the 07, 08? Jeff and Andrew and KP, you've been through this before. What do you think? How does it compare so far?
KP, you want to take the lead and I'll jump in?
Yeah, so I think what we're looking at is, if you think of the worlds of knowns and unknowns, we're trying to look at, there's a whole set of unknowns, I think, that we can all disagree on what all the unknowns are. But I think the fundamentals are the recession word. There's no way around that, right? In terms of just the economic impact, because you can't play catch up on certain things transactionally. And then just how the buying behavior has already shifted and changed with the customers of startups and all of that. So I think as we have all of our calls with our LPs, our advisors, clearly, if you look at early 90s, that was just kind of a general laggardness in the economy. If you look at 90s, the dot-com, dot-bust, that was a lot of enthusiasm around technology, but a failure to execute. If you look at every reboot of the web vans of the world, and the, web vans is now Instacart, and pets.com is now Chewy, whatever, right? So they all just kind of ahead of their time. So there's a lot of capital that went into those startups, and frankly, most of them were overcapitalized. 9/11, much more closer to what we're dealing with right now in terms of just thematically and how the psyche of both investors, customers, and startups. But at the end, and then of course the Great Recession, which the difference being when we talk to folks, the Great Recession, people did kind of have signals to see it coming. There was a slowdown. There was an elongation of cycles and sales cycles. Loans were taking longer. Things were just taking longer. So there was some indication, much like the unemployment curve that was released yesterday, which looks more like a wall than a curve. I think that's kind of what we're dealing with in terms of reset.
Well, I generally agree with what KP said. We can talk about the impact on venture investing as a separate question. Otherwise, it'll be, the first 20 minutes of this conversation will be 3 answers. On the, get 100%, like there's the overall economic drag, and then there's also how has the world changed for PropTech. So, KP's already talked about the overall impact. What we've been talking to with our portfolio startups is basically 3 slides, right? Whether they're actual slides, if they're raising a bridge round, or it's just ways for them to think about it. So number one, in the long term, is this good, bad, or neutral for your startup? Or in other words, as an investor, should you still love me, right? And in many cases, the long-term effect will actually be tailwinds for a lot of companies, accelerating things like remote working solutions, remote ability to process transactions without, paper or access controls. Those are all good or to neutral for a lot of the portfolio companies. The second piece we talk to them about is like, well, how do you ensure that you're going to make it to the long term? How can you give yourself 12 months runway? What are you doing in the very near term to like slash burn or otherwise stretch, your cash to make it there? The third one, which I find actually the most interesting, is there a near-term opportunity for your startup, right? Some startups are inherently solving problems that are relevant right now. So, in addition to urban tech, we have health tech companies. There's some of them that deal with COVID. Like they're signing deals on a virtual handshake. Everyone else is like, go away, don't talk to me for 3 months. Within the PropTech space, there are certain companies whose solutions are relevant right now. Like when multifamily operators now have everybody living and working in the building rather than leaving during the day and going to work. When they have staff that may be calling in sick. And if there is that opportunity for the startup, either by stressing things that they haven't stressed as much in the past because now they're more relevant, or by moving forward certain features that were lower on their dev list but now are top priority, or by simply by making the offer in a tactful way, there may be lemonade from lemons for them in this crisis.
Yeah, we've seen some of the data providers starting to pivot to data and analytics directly related to this situation. So that happened, I think, pretty quickly. Jeff, what have you been seeing? Because if you do a little bit later stage, I realize, but would you echo what KP and Andrew said?
Well, let me first address your initial question, which is, what is the difference, or is there a difference between the situations that have happened over the past number of decades? As KP alluded to, in the financial crisis of 2008, there was signaling in the market that the paradigm that companies were operating under, the fundamentals were beginning to shift and shake, which is why you had such a violent drop. In this case, this is a fundamentally different externality. It's a true black swan. This is a health crisis. This is not a crisis of the economy. While there were and are a number of systemic risks, i.e., very high household debt, extraordinarily high corporate debt, the economy as a whole was functioning because of the liquidity that was in the market. We're not in a position yet where we can prognosticate what the effects are going to be of this health crisis. And I want to keep on hammering that home, because this is a health crisis, and it's one where, when we're thinking about our companies, we also have to keep in mind what the human cost is. Not just a level of, are people getting sick and are they getting treatment, but also their economic situations, because this is where there's a forced work stoppage, because going to work could be endangering exponentially more people than you normally would in a cold where we know how to treat it. So I think that's the fundamental difference. At least that's how I'm viewing it.
And so I'm sure all of you have plenty of calls from founders and investors and probably even some end users. Have you sensed any panic?
Not really, right? I mean, it's really been, so we're at a kind of a fortunate situation. Our previous funds are either fully liquid or close to being fully liquid. And we haven't deployed capital out of our new fund. So we're not getting, other than our incubator companies calling us with panic attacks, which we've been having weekly calls to just kind of support them, give them insights, and really talk about, what's your next best move. We're not getting a lot of like, oh my God, what are we going to do in terms of reallocating funds to our portfolios, that are portfolio companies that are at risk, and trying to pick who we choose to survive and who we choose to kill in the process. But the LPs have been pretty like, hey, like, let's just keep talking. I think 30 days, like, we'll have a better sense. There's not a lot of panic, like, oh my God, like, why are you talking to me? There's none of that. And I do think there's some fundamentals. I'm fairly biased. To me, venture capital equals venture capital technology focus, right? It's pure tech. And I always have to remind myself that not everybody believes that venture capital equals technology only. So I think what you're seeing with the startups that are large consumers of capital, that were large consumers of capital to grow, which is not tech, by the way, they're already getting hit, right? So Compass is getting slaughtered. So I think this is where all the non-tech, non-scalable, the companies that really never had a business model that had venture characteristics start to pan out and wash out. Marketplaces are dead. E-commerce is just commerce. It's just, that stuff gets washed out pretty quickly. So all this kind of, we're going to put tech on something to try to get a bump on our valuation multiple. All that crap goes away, which it never should have been in play in the first place. And I think, but I would say the only difference when you look at focusing on PropTech, venture capital as an asset category generally has uncorrelated returns. I mean, that is the fundamentals of venture. I think I don't know that you can say that with a straight face if you're in PropTech. I think you have to recognize that there is a cyclicality in PropTech, construction tech, whatever it is, and you have to have kind of adjusted risk for that.
Yeah, we also stay on the tech side of that kind of gray line between PropTech startup versus real estate company with a little bit of tech fairy dust sprinkled on it. We do have a couple of portfolio companies that were tied on runway before. They're obviously nervous now. Well, no one's jumping off buildings yet. We haven't had NALPs tell us that they're not going to make capital calls, knock wood. That's when it's really bad, if you have an LP that's like just willing to walk away from their interest in the fund, but so far not that yet. So in that regard, my general feeling right now, and based on a couple of conversations I've had internally and with other peers, is that in another month or two, VCs will, and even already now, will start deploying capital again. The terms will be different than they would have been 2 months ago, but we have structural reasons to have to deploy cash within a period of time, and there's still opportunities out there. To Jeff's point, this isn't oh my God, the fundamentals of the real estate world were wrong and now things have changed. this is something came out of left field, sideswiped us, and may or may not have as big an impact on those kind of long-term fundamentals. Now, if the recession comes really deep and everything's on hold, then it's a different matter. But it's really just a question of how much longer a certain deal is going to take to consummate.
Yeah. Hey, so here's a thought. There was this narrative that there was a hell of a lot of dry powder out there. And this is related to a question that just came in. How big is the buffer? Maybe we had a lot of undeployed. KP, you mentioned undeployed. Andrew, Jeffrey, Jeff, I don't know how much undeployed capital you have, but what's your sense of that situation?
Jeff, why don't you go first? We always jump in.
Sure. So we have quite a bit of dry powder in our third fund that we just started deploying. I think, and related to your last question, so the panic that you're seeing is from a cohort that was spending and where their unit economics weren't necessarily in a position where they were ever going to be able to get out of the hole that they were digging by adding additional capital to their stack, spending to get growth, which was artificial growth. I think KP mentioned a number of companies that you can look to that as the model. There is a lot of dry powder, and again, I would go back to the point that I made earlier, which is that when you've had a period of, some would say, artificially low real interest rates, so there's a ton of liquidity in the market, which is why so many funds were raised in all areas of capital deployment strategies. I think you're going to see a tightening from an underwriting perspective. It's going to be more difficult for people and for certain groups to deploy. But I also think it's going to continue separating the best of breed from the rest. And I think you'll still end up getting a lot of capital deployed into places that are not necessarily venture capital appropriate, like KP alluded to, and the ones that are able to deploy into the best companies are going to see even better outcomes.
Yeah, there was PJ Parson from Spotify was quoted as saying the return of sustainable unit economics will be extremely important for startups that want future funding. I was struck by that, though. Shouldn't that always be the case? Why is that suddenly news?
Look, I think it's time for the kids to get out of the pool, right? I mean, it's Adult Swim. Kids get out of the pool. The amateur hour of VCs that have never done it. This is where they struggle. I think when we have been super deliberate and disciplined on fundraising for this fund, where we're not allowing more than half of our LPs to be strategic. The other half are sovereign, ultra high net worth. Like, they don't care about PropTech. They don't even know what the fuck PropTech is. They don't care. All they know is they deploy capital to 30 managers, and you just better not be in the bottom third, right? And those LPs are like, yeah, man, like, this is great. This is a great time to deploy capital in this asset class. And so they're reconstructing how they deploy capital. But I think, the corporate innovation folks are gone, right? I don't see how companies that are real estate focused, that have a ventures innovation group, the CFOs are in charge. If your number is not attached to revenue or cost reduction, you're on a list. When I was running a public company in 2001, we had 3 lists: high, medium, and low, depending on how bad it was going to get. And it was a list of people that we were going to lay off, right? Mm-hmm. This is how people have to be thinking. CFOs own the C-suite right now. And I think this is where kind of the amateur hour doesn't work. And the corporate VC stuff, we were already starting to see it pull back. But, if you're a chief innovation officer at a real estate company, dust off the resume or go find some assets to manage so that you will survive.
3 quick points, because I love going last and I can be quick. Number 1, Jeff, I did not drop the first F-bomb. Shocking, right? And number 2,
you got to get caught up, Andrew.
Totally agree. Like the big impact is not going to be on the VC side. Like Dream It also, we're less than 1 year into our third fund, so you have plenty of dry powder. It's strategic investors in the deal, and they're going to be on the sidelines for a while. I have a maybe slightly different perspective because I used to be a generalist. Dream It also has 2 other verticals that are totally unrelated to PropTech. I would say within real estate, the involvement of strategic investors at the early stage is higher than any other sector I've been involved in. There's just a lot more of that money in a higher proportion of the deals. So to that extent, it's going to be that much harder for PropTech companies to raise their rounds relative to other industries. It's going to be harder for everybody, but with the strategic money going away, it'll be a little harder if you're raising money in that respect.
That might actually be a good thing. That might be a good thing, because a lot of these companies that you and I have seen, in particular, Andrew, and KP, I'm sure this is the case for you as well. Actually, let me take a step back. So Camber Creek's investment thesis is predicated on 2 questions. The first is, can we use this product software service within our portfolio matrix, which we define as the buildings we and our LPs own, the tenants, residents, guests, et cetera, who work, live, and stay in those buildings, and the vendors who serve all 3. That becomes your ecosystem. And over 1 billion square feet, you've got millions of relationships that can be leveraged to the benefit of both our LPs and portfolio companies. The second question, which I think both KP and Andrew will nod their heads at, is there a viable path to a venture return? The vast majority of the companies that we've seen do not have any hope of creating that venture return scenario, because they're not scalable in a way that is going to allow them to get the heavy lift without raising massive amounts of capital that it's just really not appropriate for. So that potential disappearance of the early strategic money, the real estate groups that have benefited from crazy amounts of liquidity, they may think twice before putting money in it and saying, you know what, maybe this isn't something that we should be entangling ourselves with, and we should focus on our core business. And I think that might be a good thing, because it will lessen the amount of false starts in the industry. And this is, it's still pretty new. We've been involved in PropTech, I would say, from the very beginning, starting in 08 and 09, when PropTech wasn't even a buzzword. And I would say we're still at early innings, but this is certainly going to have an effect on the amount of groups that decide to participate in the funding of these companies.
Yeah. That's actually, I want to, oh, sorry, KP, you go.
No, go ahead, Andrew. I always feel like
I like going last. Okay, I'll be quick then. Totally agree. The strategics sometimes drive pricing of a roundup too, right? Because to them, it's in some ways almost less important what the ROI is than it is that it be strategically important to their business, almost to a ludicrous extent. So, that kind of like synergy based, like I want to invest, not so valuation sensitive investors, I think they're gone right now. So that'll certainly help us on deal terms in the short term. And as an industry as a whole, like they'll grow into it mentality that some of the newbie investors or the strategic investors who are actually less concerned about their unit economics and how it helps the mothership's business, like that's gone too. So a whole bunch of startups that maybe should never have been funded will not be funded. And what that means for the rest of our portfolio is that the field is clearer, right? It's like a brush fire in the Amazon. When you get rid of the dead wood, the rest of the forest thrives. So it's going to be good for us in those 2 ways.
Yeah, I think it's interesting. So I had one of my analysts pull together some of the larger PropTech funds in their portfolio company. I was like, can you put a brief together? Like, go through their websites, give me a brief. And his brief was, they're fucked.
That's 2.
Right?
That's 2. Thank you, KP.
Right. And I was like, thanks, analyst.
Yeah. How about a little more detail on that?
Well, that's all you need via Slack, right? It's a binary point of view. But I will say, like, just to walk through kind of this as an entrepreneur, the startup point of view. I'm a startup. I had this idea. I want to disrupt leasing offices because I think leasing agents are a waste of time and have no place in this new world order. I'm going to disrupt it. So I built a business model around disrupting leasing agents. And then I go out for capital and the PropTech people go, oh, I don't know about all that. We're not ready for that. I don't think that's really how it's going to work. So in order to get the check, they pivot a little bit. So they start to look tech enabled. Oh, we're going to help the leasing agents and we're not going to be pure tech. And we're going to create a mediocre company because our investors have told us the only way to get the check is to not make waves and pivot into something that has less friction. My point of view is those companies now, it's time to go back to your original business model and your original thesis, because you might actually have a window to go execute on these places that had high industry friction and cultural friction. This could be the time for you to pivot to your original plan and be a pure tech play. And we've seen a couple companies that we passed on last year where like, dude, you're a marketplace, you're tech-enabled services. And basically their angel investors were real estate people that said, well, this is the only way we would buy it. And they've come back and said, hey, what should we do? I was like, it's time to like shift the model and disrupt, because you may actually be able to. The one thing that's been interesting about the health crisis is all of a sudden people, like, we're doing this remotely. Like it's all of a sudden these weird cultural things that real estate, who's always like 10 years behind culturally, right, around thinking about disruption and innovation, all of a sudden have been forced to catch up. And so are they going back to the old ways, or can you convince now a multifamily property, yeah, leasing agents are a waste of time, you should do everything via tech? They might actually say, no, you're right, like leasing agents are a waste of time.
Yeah, don't waste a crisis, right?
Right.
Well, so as an example, let me pick one example out where there's the intersection with travel tech, hospitality tech. The category of Sonder, Blue Grounds, Selena are getting hammered because of hospitality. Do we now reveal the model was never sustainable from the beginning, or are they victims of the current environment?
I don't want to say that was never sustainable, but a Sonder is a real estate or a hospitality company with a tech overlay on it. Same at the end of the day, we work also, right? Real estate companies. There are successful real estate companies out there, but they need to be funded and run as a real estate company or as a hospitality company. Trying to run that as a tech startup just because you can convince some people that, hey, there's some tech on top of it, like that's the recipe for disaster. So I just want to be clear. They might have, I think Sonder would be a great product, right? I've never used it, but I think it's a great product, but it's not a tech product.
Look, and I think the fundamentals, right? I've had plenty of startups I built that I got a valuation I didn't deserve because of market conditions. I was very good at that, right? As an entrepreneur, you've got to be good at that, right? Like, let me get a little bit more, right? But that also put the pressure on me to grow into my valuation, right? I might have gotten a little bit more because I was able to convince somebody to give me a little bit more. But at some point, I had to grow into my valuation. Most of these companies are not venture, they're not venture plays. They got very high valuations that they were never going to grow into their valuation. Uber is not a technology company. They will never grow into a tech valuation, right? Airbnb is not a technology company. It's a marketplace. They will never grow into their valuation. So I think the challenge is when you get early capital at a frisky valuation, can you actually execute in a way to grow into it? And I think that is the core thesis of building a tech company, right? Go sell something, go build 5 slides, go sell something and get overvalued on your idea. But now you have to go execute on it to grow into it or shoot it, right? Those are your choices. And so I think fundamentally, none of these companies could have ever grown into their valuation because the expectations were set so poorly on the front end.
But part of the reason they got those valuations, again, goes back to the liquidity available in the market and KP's ability to adroitly play one investor off another and say, well, listen, this company is going to give me terms at X. If you're not at 1.5X, I don't know that we can do business. And because there's so much liquidity, that's what was allowed to happen. It will be very interesting to see what companies like Sonder and Lyric, which are lease arbitrage companies, that's what they are. They're leasing a building and they're trying to relet it for a higher price. And if they've raised enough money where they can wade through a period of time where they're not going to be letting out these rooms and these apartments, then they'll survive. Their future funding rounds may look very different.
Yeah, there's a saying that like everyone's a genius in a rising market, right? They don't look so smart now in a falling market, perhaps.
My
But,
kid
we'll
was
see.
up 52% in the public markets last year.
Well,
He's 19.
okay.
He does some homework, but he's 19.
KP, I wanted to come back. You were commenting on the strategics, and that actually your funds, you're trying not to be overweight on strategics, or on the corporates. What role? This is a question that came in. What role will they have? Do they end up coming back to just being really good customers, or how do you see that unfolding?
Well, who said they were really good customers?
Okay,
Customers are good
enough.
to have. Some of them are good customers too.
Yeah.
Yeah, I don't know. I'm a little difficult at times. I mean, I think our strategics that invested did not invest because they were going to be customers, or because they invested because they wanted to learn. It's a cheap way to get signaling in the market, to learn about new innovation, kind of have someone keeping one eye open at night while, I don't want someone to come along and disrupt anything. I don't think they necessarily, their mission wasn't like, oh, I'm going to be a customer. I think we're just too nerdy. There's a little bit of a technical thing with us that I think most of them wanted signals around what tech is being adopted. If you listen to your CIO or your CTO about what's next, you'll always be wrong, right? You'll always overinvest too early, you'll adopt too early, and you'll have failure in a large company. I think they use us as much as a signal around, is it really time for AI, or is my CTO says 2020, we should be all AI. They start to see what we're doing and get signals around this type of startups we're looking at. And they're like, man, AI is like 2022. I'm going to go tell my CTO we're not spending $1 million on AI this year. So I would say their bent is a little bit, but I think our thesis around not, having more core investors, the test of a venture firm is how many of your LPs invest in your next fund and how many of them up the ante. We've always felt with strategics, there's always, regardless of cycles, there's always going to be a ceiling to that. Versus the professionals that say, I manage X billion dollars, I allocate 5 to 10% of that to venture. You're now in my stable of venture fund managers. They'll always have an appetite. There's no sovereign wealth fund saying, oh, we'll never invest in venture again, right? They're all just like adjusting allocations. So that was really our strategy, to not allow all strategics, because we don't think strategics, like right now, hitting them up for more money for your next fund, it's probably a little tough conversation, especially if they're real estate focused.
So we don't have strategics in our fund, but that was more outcome than design, because we're in 3 verticals. So if you split a $50 million fund in 3 verticals, it's hard to go to a strategic and say, give me $1 million, give me $5 million. The first $3.5 million are going to go into 2 industries you don't care about. Right, maybe down the road, we have larger funds, we'll have sub funds, we'll take the, that money. I'm actually not as negative on taking that money into the venture fund, in part because more powder is always good, but also, our focus on the accelerator part of our business is because we deal with the companies that are like usually kind of post-seed, almost always post-seed, post-revenue, kind of corporate ready. We want to get them as many customers as possible so they can raise their A rounds. That's really where we're looking to deploy. So having an LP who's put money into the fund, generally speaking, all the things being equal, makes that, it makes it a higher priority for them. Like, why did I spend all this money if I'm not actually going out there and looking carefully at these startups to partner with? But we don't have it. So I'm actually kind of interested if I have strategics who are now, they're getting, I run a lot of, let's say pretend I run a lot of commercial office space, and a lot of my hospitality and retail tenants are telling me I'm not paying rent this month. I just don't have the money. I wonder if that will actually lead to like missed capital calls. I just don't know.
Hey, I've got a question for Jeff related to this. On the institutional side, in our earlier conversation, we briefly discussed rebalancing. Do you think that's going to be an influence where the institutional LPs are rebalancing and making decisions based on that?
I think it's going to be too early to say. The ones that have made their commitments already, and KP is probably in a better position to answer this question. I don't think you're going to see them trying to walk those back. But it's also very early. We're in a market right now with extreme volatility because of the unknown unknowns. So I think I would not feel comfortable making a declaration one way or the other.
It might have also been you who mentioned that there might be a wealth effect on angel investors, or maybe KP. I forget, one of you guys mentioned this.
Yeah, I think Andrew brought it up that rich people playing VC. Like, hey, I made a bunch of money. I got some extra money. I already got 2 Ferraris. Why do I need a 3rd one? Let me throw some money in this startup because I've watched too many episodes of Shark Tank and I think I'm Mark Cuban, right? So those assholes. So those once again, kids, it's Adult Swim, kids out of the water.
Yeah,
I think
they're not writing checks for a good thing. You don't look.
They
if you're
shouldn't
an
have written
angel.
them. Yeah, they shouldn't have written them in the first place.
True. You know what? Like I'm ambivalent about it because if they lose a lot of money funding 10 startups for one of them that falls into my strike zone later, they've done me a service. That's a positive externality. It sucks to be them, but it works for me. It's fine. And it sucks for the entrepreneurs, I guess, but it's more deal flow for us down the road. But you don't look at your portfolio and see that your public stocks are down by 30% and suddenly say, yeah, now's the time for me to tie up money for 10 years.
Actually, the good news, Steve, is we don't give a lot of signals, right? None of us are sending emails to our LP saying, oh, as of the last 24 hours, your investment is now down or up. Like, I think, unless people start doing down rounds, and you have to start kind of thinking about that. And of course, if you loved the idea when it was overpriced and they're doing a down round, maybe you're gonna follow in and you're gonna love it even more now. I do think, I write about an article a day because I should have better hobbies. And I wrote an article back in January saying like PropTech is dumb. And I do think since we have a quorum here and Ash hasn't cut me off, I think we need to kill the term PropTech. It's really just enterprise software. It's enterprise hardware. There is no reason why you would call it PropTech. And now that real estate's probably going to go through some shifting and moving, probably not a huge benefit to advertise that you're associated with real estate these days.
Well, I don't know. It's like ad tech is suddenly MarTech because they can't say ad tech and raise a penny. I don't think it's that bad. I will say, like,
you're better off calling it enterprise software, right? Like,
yeah. So the only thing is, like, I'll keep PropTech, but like, apologies to Michael, I am not saying CREtech. You guys can own that. I'm not going with that.
I thought it was CREtech.
I'm okay with that. I'll accept that, but something about CREtech, I don't know. Kidding aside.
CREtech.
So I had a VC remind me that venture investment is supposed to be long-term. So are we overly concerned about COVID-19? That was the question.
Well, you have to get to the long term. So if you have startups in your portfolio that are great in 12 months, but die in 8, that's going to be a problem. But, again, like, Dream's been around long enough, and we've been around since 2008. Some of our best investments were 2009. Mm-hmm. Right. So, there's fewer people throwing money at deals. You get better terms. The companies that you invest in face fewer competitors. Like, it's good, right? I mean, generally speaking, if you look back at like 2008 and 2009, it was a short pause. If you go back to like 2001, it was a longer pause because it was a pretty deep recession in the valley. So I guess in some ways it will come back to the overall macroeconomics. Like if everyone is dead for a long period of time, I don't know, I guess I'll learn how to play golf.
Okay.
It also depends on...
I'm going to read the quote. You go ahead, Jeff.
I was going to say it also depends on what you're talking about. panicking about COVID-19. Again, we just don't know enough about it yet to be sanguine about what 3 months, 6 months, 9 months, 12 months might look like for the global health environment. Forget the companies for a second. Like every dislocation, there is opportunity, but this is very serious. There are people that don't think that they have that this affects them, and it does. Whether it's the economy, all the restaurants or stores on a block closing, which means putting people out of work, and then knock and drag on effects that's going to have to just everyday life. So I do think we should have a help, like we should remind ourselves, this is serious. This is really, really serious. It's but the companies that are putting themselves in a position and continue to put themselves in a position and have put themselves in a position to weather the storm with a strong balance sheet and prudent business decisions, they will make it through, but they're also the ones that are not panicking that the sky is falling. So you have to separate those two things.
Fair enough. I was going to read a quote, and then you can tell me which of our panelists said this. This pandemic is acting
Andrew.
as a catalyst to complete the digital transformation of business models that were not fully executed given the technology available to us.
Too many syllables for me.
Too many syllables for
I may have said something similar to that.
That was me.
Yeah, it was KP. Yeah, so there, and this is, our good friend Michael Beckerman said in his editorial today, there was a lot of silly money chasing silly investments that didn't make sense even in the best of times. So maybe this pullback is a good thing.
Look, I refrain from using the word good in anything right now. There's kind of I had to have a conversation with one of my big LPs, like, I am struggling with being opportunistic and being a good human at the same time, because I think we're all going to struggle with that a little bit, right? There's definitely going to be opportunities. I don't think any of us want to see opportunities created because of this. I don't think as humans we're really interested in exploiting kind of a bad situation. But I think, there will be, right? There will be the fundamentals. There will be. So I try to refrain from the word good these days on any level. There is nothing good. There is nothing good coming out of this. Bottom line.
Yeah, you got to restrain your inner dick here a little bit, right? I mean, we are trained to look at everything like this through a very specific lens, right? And it's our responsibility to our investors. We have to look at this through the lens of where are the dangers, where are the opportunities, what's that going to do to the portfolio. But when we go out there and when we talk to our portfolio companies or when we negotiate new rounds with them, we have to be very, very empathetic and tactful, right? So even when there are those companies I alluded to earlier that have an opportunity to make lemonade out of lemons, if they're perceived as selling in a crisis, or they're perceived as being kind of profiteering, it's going to kill it all, right? So I've advised some of them, like some of them are giving away parts of their product suite for free, which is a smart move for them because their customers weren't going to pay for it now anyway, to a large extent, and it gets their foot in the door. I've told them, like, you have to communicate it the right way. It's like, hey, I'm not selling right now. I know you guys have this problem. I'm doing this for free, no obligation. I just want to help you make it through it. At the end of 3 months, you want to tell me to go fuck off, that's fine, right? But you got to understand the tone of the times we're in and not lose sight of it because of our specific training on how we look at the world.
Yeah, and I think we did a couple things. One, I posted my Calendly link to Twitter and said, hey, anybody need to talk, book 15 minutes with me. My son, who sits in my home office with me, thinks I should turn them into podcasts because some of them are great and helpful and I'm helping people. Some of them are nothing but entertainment value. I don't know that I recommend putting your Calendly link on Twitter. But
I want the entertainment value ones, please.
Besides that, we took our community platform and in 2 weeks we kind of recoded it, reskinned it, did a bunch of stuff. and just kind of said, look, we've typically used our community platform for our companies, our, people that have a vested interest in our startups. And we basically reskinned it, redid it, and published it out to the world and said, hey, we're just going to let people use it for free. So if you want to, and I think you should try to be helpful to the extent that you can be helpful. And I think we all forget there are some things that are very easy for us. And it's so important that we're helpful to do the things that come easy for us. I've been through multiple scenarios of having to do, large size reductions of staff, large staff reductions. I've offered my time to CEOs of large companies saying, hey, if you just need another voice to go through how your strategy on staff reductions should look, done it a half dozen times, happy to help. And so I think it's important that we all offer our time and energy for the things that come easy to us, because sometimes the stuff that comes super easy to us is really fucking hard for other people.
So this was a question that came in regarding, by the way, thank you all for that, because this idea of empathy and the human aspect of this should not be lost on us. We've got to continue to run our businesses, but it's a critical time. So thanks for putting that into the conversation. This was a question that came in. Can any of you speak to the perspective outside of the US, what's going on elsewhere, so that we're not only in this US bubble of thinking?
I got nothing. Sorry. I mean, most of our portfolio companies operate here. Some have feet in other geographies, but I'm still digesting what's happening here.
Yeah, we have a number of LPs who are European. I would say that they're facing a similar situation. They don't have the same leadership and the same debate, the public sector debates that we might be having, but this is a global crisis. And that, if there is one good thing, actually, KP, there might be one good thing, which is this is a unifier. This is something that does not have a border. And the interesting thing that we have seen, where our LPs, and a large number of them are strategics, are owners of real estate and operators of real estate, where the questions that they're now grappling with are global instead of hyper-local, which typically real estate is hyper-local. But you have this question of, well, what's going to happen with my debt coverage ratio? What's going to happen if my tenants can't pay on time? What's going to happen if they're forced to close for a certain amount of time? And I think that is bringing people together. So that is the one, I could say, if there's one positive, that's it.
Yeah. Steve, a large chunk of our LP base is Asia, and then another chunk is Europe. We actually have much fewer kind of domestic LPs. And I think I learned from them. It was interesting. One of our LPs in Japan had me give them a 20-year firm plan. Like, what is your plan for the next 20 years of your firm? I've had no other LP ask me this, right? Because it is a long view of a relationship. They asked me if my kids are going to be in the, what is my succession plan? I had taken my son with me to Japan because it was last summer, and they got to meet him over lunch. And they're like, oh, is he going to be in the business? It's just this different way of thinking around kind of the larger view of the world and the time horizons. And I think in America, kind of the financialism of living quarter to quarter. I've run 2 public companies. I'll never do it again, because the lifestyle of quarter to quarter living, what I'd like to, and so I think those LPs, they always had a long view of what our mission and how we view the world. That's just how they're wired. I don't think they think about it that way. Mm-hmm. So conversations have been very different. I hope maybe through, part of my hope narrative around this is that American business starts to be a little bit less quarter to quarter thinking, a little bit more. Let's think about the long view. Let's think about impact. And I think a lot of my European and Asian LPs, I had said last year, like, hey, innovation's been kind of killing the planet. Let's start investing in innovation that'll save the planet. And a lot of the narrative around that has been, This pandemic is the planet fighting back. Skies are clear, water is clear. A friend of mine in Seattle said he's never seen this many bald eagles out than ever before. Like,
you sure they're not carrion vultures?
Maybe, right? So I do think there is a mindset that I hope we can start to adopt in America around just not trying to live quarter to quarter, but actually have a long view and stay true to a mission. So the feedback from, they got it early, like they dealt with it early in terms of the day-to-day stuff. But I think they're pretty strong in their thinking. This is a blip on a very long journey.
Yeah, we had one of our listeners describe this as Nintendo-style company planning on a 20-year plan. I was struck by when I learned that the ADIA investment fund has a 100-year time horizon. I mean, that's just remarkable. So I think what we'll do is we'll take some Q&A, some additional Q&A. I've been putting a little bit of Q&A in here along the way. And one question that has come up a couple of times already is what kinds of ventures, what kinds of application of technology might we see more of? Not so much what should we be pursuing under the circumstances, but where can technology be applied to solve some of these problems? For example, will this accelerate the digitization and frictionless transactions? Will it accelerate AR, VR? Does construction tech suddenly explode forward? How might this unfold?
I can give you a real-time example that's happening right now for one of our portfolio companies. We have a company called Notarize, which some of you may or may not be familiar with. They are a digital notary tool. And in the last number of weeks, their business has spiked to a level that they've never seen because of necessity. You can't go and get a notary to come to your home or come to your office because you're not going to your office. And notary is something that is mandated at the state level. So this is a company that went through a lot of pain, a lot of money, and a lot of effort in order to get digital notary services allowed at a regulatory level. And indeed, New York, which has been traditionally a laggard on a lot of these productivity type tools that cross over into areas that require legislation, just passed a temporary stay on the ability to digitally notarize. So I do think you're going to see a continued trend to the digitization of various workflows, specifically as pertaining to real estate, at a necessity.
Right.
Yeah.
Other ones, guys? Other?
Yeah, so I think there's certain things that are happening right now where you'll never be able to unring the bell, right? Like, I'm an investor in a couple of telemedicine deals in my personal portfolio. The biggest issue with telemedicine was all these regulatory barriers, that you could only serve a patient that you in your state. That's been lifted, right? So I don't see how you rationally go back to saying, no, we're going to go back to where we were. We've seen some municipalities that deal with, there's no such thing as online permitting. You have to come to the office and get a permit, that have been forced to go digital. I don't see how you go backwards on that as well. So I think there are some things that were regulatory dependent. Whenever I look at startups that have this regulatory hurdle, it's like, unless you have a great lobbyist and a ton of money, good luck with that one, right? So I think if you track some of this stuff where the regulatory hurdles have been taken away on a temporary basis, you have to question whether they'll actually come back, right? And so I think we're looking at some of those. I think from a pure tech perspective, VR, AR, I think it's interesting, right? I think, and I'll just tell a quick little story. I have an LP that's like super old. And last year I sent him a Zoom link, and he said, KP, what the fuck is this Zoom link? Why can't you set up a conference bridge like normal people? Like, why can't you just set up a conference bridge like normal people? And I'm like, okay, fine. I'll send you a dial in. Last week, cause he's old. Last week I called to check in on him, see how he was holding up. And he's like, KP, this Zoom thing is fantastic. You should see if you can invest in them. And it's like, wow, okay. So I do think there are some people that have been forced to adopt things. They're going to come out of this and say, okay, like we can, let's just keep doing it this way. Right. So I think there's kind of the scar tissue and how that drives like social patterns and how we look at how we want to live our lives. But I'm really tracking the regulatory stuff, like what gets undone. And then I think, you have to look at industries that need to play catch up, right? I mean, hotel industry can't really play catch up. You can't, short of inventing the time machine, you can't go back and rent those rooms that have been empty, right? But there are places where you can play catch up. And I think construction tech is one of those, right? If you can deploy technology that takes a job that's behind now 2 months because of this, and you have an ability to accelerate it and get it back on track, that's kind of interesting too. But we've been tracking the regulatory hurdles a little bit more closely.
So it's funny that you started with tele. Like TechCrunch came up with a piece. They surveyed a bunch of us about the impact of COVID. And my piece starts with like, this is the time that tele went from nice to have to must have. And I specifically call out health, education, and remote work. We didn't mention this before, but one of the verticals we used to be active in is in ed tech. And we also are active in health tech. And in both those cases, you had resistance, partly regulatory, but also partly, attitudes. It's like, it's nice to have like, we don't have to figure out how to help the kids learn remotely because it's really only a couple of kids that are sick from time to time. Well, my kids' school, 2 days, everything's on Zoom. They think they're experimenting with different platforms, right? They had to do it. And where it's not regulatory and the barrier was, how do we work through this, or do we really have to figure this out? Those are gone, right? They figured it out now. So there's no going back, right? These are now going to be tools in their tool chest. In the remote work environment, you still have a lot of old school corporates who are like, I don't know if my kid, if they're not in the office, are they really going to be doing stuff, right? So now they figured it out. And not only that, not only have they figured out that like remote can work because they have no other choice, right? They have to figure out how to set up VPNs. They have to figure out how to measure productivity when people aren't in the office. On the flip side, now they have a very, very close and personal example of why working from home kind of sucks a little bit, right? Mm-hmm. So they'll be looking for, what are the other tools? Like, they want to come into the office. Should I buy like a ClassPass set of credits at a co-working space? They're already, the resistance to remote working in general, gone. The temporary, we have to think through this, resolved. And then the next step is, okay, how does this become a normal part of our world going forward? Like, those things are never going back. And on the regulatory side, the truth is, the dirty little truth, anyone who's done poli-sci back in the old years, is a lot of the regulations are industry capture. Right? A lot of the regs are in place to protect the industry incumbents from competition. And once those are smashed, it's hard for them to put it back in. Like, they're all saying, we can't do this anymore. The world's going to collapse because we can't do it safely if we allow people from like New Jersey to do this in New York. Well, okay, we just did because we had to and the sky didn't fall. For them to go back and say, we should re-regulate it because those Jersey guys are suddenly going to get dangerous again, right? It just hasn't happened. So I'm not worried about re-regulation, generally speaking.
Yeah, I would agree.
So a couple of questions while we're on this. There were a couple of questions about, is co-working dead? What about WeWork? Is this the new normal, working remotely? That's a whole Pandora's box. To your point on when the genie's out of the bottle, I think this flexible working and the, let's put WeWork aside and even co-working aside, the relationship that we have with the built environment is very, very different. And I don't think that gets undone. I don't know what that looks like in the future, but what's your thought on, and there was even one comment here was, shouldn't the scalability of something like co-working, given that the world is getting increasingly flexible, shouldn't it become even more popular rather than under pressure, aside from the business model? What do you guys think? Without going too
I'll
much
jump
down
on
the
that.
rabbit
Like,
hole.
are they dead? Well, that's a real question. Were they alive before? We've talked about this before. They're real estate companies in a venture cap structure. Like, that's going to change. Underneath it all, is there a viable real estate business to be had? Probably. Like, do they need to be restructured? Are equity holders going to get screwed if they go through a bankruptcy process? Maybe, right? Fine. Not going to talk about that. That's less interesting. The bigger issue is, are these kind of flexible work arrangements, are they going to be advantaged in the long term? And I 100% think they are. I'm going to give an example from our portfolio, not because I'm talking my book, but because it's the starkest example that I can think of strong long-term tailwinds and horrible headwinds. So the company, it's called Kettle Space. What they do is they take underutilized restaurant and hotel space, like off-peak event spaces, and they turn that into a network of co-working rooms. So they are a co-working network without the assets, right? And they're helping those other two-sided marketplace, blah, 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 all those kind of buzzwords. They help those guys make more money on like dead time in the restaurant, and they help other people have co-working space at a fraction of the cost. In the long run, something like that could be incredibly valuable to employers as they're trying to incorporate the ability to work remotely, but not necessarily at home, into how they manage work, and whether it's a benefit, whether it's just how they need to do business. So I'm very bullish on their long-term prospects. In the short term, they closed all their locations. They're not collecting membership fees. Like, they're at like zero revenue, and they pretty much think they're going to be there for at least a couple of months. So it's could not be a starker black and white long-term versus short-term for a company like that.
Long-term versus short-term. Hey, Jeff, you've got over 1 billion square feet. What's your take on this?
Well, on the flexible, on flexible everything. It's not just flexible workspace. It's also
it's everything.
The hospitality. It's the way we utilize real estate is fundamentally changing and evolving. But you have to take a step back and realize that the changes are going to be manifest when the financing component changes as well. And what I mean by that is, if you look at the way office buildings trade, when you buy an office building, if anyone's ever bought an office building, they probably have received something called an Argus run, which is a 10-year run of cash flow that you can base your net income on, which is how you underwrite it as an operator and how your bank underwrites it as a lender. Well, the issue with flexible space is, how do you underwrite that? So it's the same thing that happened in the hospitality industry, a similar thing that happened in multifamily. The reason multifamily was easier to underwrite, even though leases tended to be year to year, is that an apartment building will always lease, no matter the environment. It's just a function of price. Whereas office space does not have the same levers. So once the financing apparatus, the financing environment, the financing world catches up to where multifamily currently is, you will see buildings flex between uses more easily.
And as a long-term, outcome for the economy, that's great, right? You should be able to flex the use of an asset for what the most productive use of that space is. So you add a couple more floors as hospitality when the environment is right, and you take them off and you use them as multifamily when the environment is different. But yeah, there are other external, either actual regulatory or industry practices that add tailwinds to it. And the interesting thing that I found is part of the reason the entrepreneurs that I see in this space are almost invariably people who have years of experience in the industry, as opposed to other industries where there's more appetite for like, oh, I'm a SaaS guy, I'll figure out your industry, is that there's so many of these nuances that if you don't know it, you're just not credible, right? The door shuts in your face from the very beginning.
Right. I think, and if you look at, we have a portfolio company called Y Hotel, which is related to the Sonder and Lyrics, except the difference is they don't lease the space. They partner with the developers. Mm-hmm. So they are somewhat immune to what's currently happening because they don't have leases that they're paying on. If the rooms that they are, and actually I can go over their business model because the business model is quite ingenious. What they do is they partner with multifamily owners and operators, and they tend to have more opportunity during down cycles because a typical building that's built, multifamily building, will lease up between, let's say, 8 and 12 months. In a down market, that lease up period, the stabilization period, might take longer. It might take 12, 18 months, 24 months. And the reason why that's important is going back to my point about financing, is that most developers want to go from a construction loan to permanent financing as they stabilize the asset. Y Hotel partners with the development firm and creates a pop-up hotel that, as the occupancy of the building goes up, the number of available rooms in the pop-up hotel bleeds down until it disappears. And it's a found source of income for these developer owner operators. They have exploded in popularity over the last number of years, specifically because the liquidity in the market has created an environment where there are so many cranes in the air because easy money makes everyone a genius. I think KP said that before. So the structural effect of the defect of too much money creates too many apartments and apartment buildings, and Y Hotel helps deal with that. But they're not leasing any property, so this has no effect on them. And they have actually a branch of their business where the buildings themselves can flex between uses. The idea that you can utilize underutilized space. And I think that's what Andrew was alluding to earlier, where some space, like a kettle space, where if a restaurant is only open from 5 p.m. to 9:30 or 10:30 or 11:30 p.m., they're paying rent 24 hours a day. They should figure out a way to utilize that and earn income that they otherwise wouldn't. Of course, they're in a situation right now where it is not tenable, but the Y Hotel buildings, the way and the way operators, once the financing world catches up with that, and again, that's real. I can't stress that enough. The ability for buildings to flex between uses, I think, will become more commonplace.
We think that this idea, you guys have heard us at the center talk about this idea of fracking for a number of years now. We think the continued optimization of use of the built environment, that will continue. That's never going to go away. Maybe it'll even accelerate now. New and innovative ways to use space that was underutilized or not optimally utilized. We think that's going to just going to continue, and it might be accelerated by this current situation. KP, do you have any comment on that? KP, can you unmute for a moment? Hey,
Yeah.
he's back.
Yeah. So, in like 1998, I saw Cisco demoed their telepresence because they were an investor in one of my companies. They demoed the telepresence thing. And my immediate reaction was, the airline industry's dead. This is amazing. Why would anyone ever go through the pain and suffering of flying somewhere? And of course, that didn't happen. But at that time, there was a book called The Roaring 2000s that was published by Harry Dent in 1999. And he talked about the exurbs, right? Like, with all this great technology, why would you ever live in a city center? Why wouldn't you just live in the woods or whatever? None of that happened. So there's part of me that wants to live in the woods. So I think part of not just utilizing the assets that exist, but also how are people going to just change? Are they just going to say, you know what, if I can now work from home because my Luddite boss all of a sudden thinks that Zoom is cool and I don't have to come into the office. Do I care about living in a city center? I had a friend of mine tell me he just realized how terrible his community is because he lives in really one of these hipster kind of concrete places. And he's like, you take away the bars, you take away the coffee shops, you take away the restaurants. It's kind of terrible. Like, it's just concrete everywhere. It's not that great anymore. And he's like, I think I'm going to move. I think I'm going to move out of the city. So I get fascinated by the kind of the cultural aspect of how people are going to rethink.
So I'll take that, and I'll take it up a level even, right? So those of us who are like closet or not so closet sci-fi geeks, remember even back in the 50s and earlier, people were talking about how like cities would be dead, everyone would be like, telepresencing. And it hadn't happened, for the past 70 years. And I don't think it's going to happen going forward, because there's a deep-seated desire among people to be physically around other people. I think some people now, if they're stuck in the suburbs, may also be deciding, oh my God, it was only tolerable because I got into the city to work. There's some of my best content is coming in on WhatsApp, and there's a video, I don't know if you've seen it. It's like just it's a black guy, and he's being told on the phone that like he's got to quarantine because he's contracted the virus. And like option A, you can quarantine with your wife and children, and option B is, and he goes like, option B. I'll take option B. So I think there's going to be a lot of that. Like I don't think there's going to be a massive reversal of urbanization at the end of the day. I don't think there may be short-term blips where people are like, oh, well, it's safer in the burbs, like I'm less, but I think long-term, like the fundamental, like the inner monkeys in us are still going to be around people.
Depends on how many December babies we have.
I have other memes I'm getting that I cannot share on this call that talk about that too. So just to wrap up that thought, right? I think in some cases, the reason people didn't want to live in the cities for so long was because it was dirty, it was shitty, right? And we've actually fixed that. The cities have become better places to live over time. And as long as that continues, I'm still bullish on urbanization, but it will change a lot about how we live in the city.
It'll cause us to reconsider. So I'm going to close with one question that came in that you guys can riff on. The question was, what advice would you give to a PropTech company looking to raise a pre-seed round right now? And my final question was, for a startup, what do you focus on now? What do you look for in the months to come? So coincidentally, my closing question was similar. What can you tell them?
Pre-seed startup trying to raise their first round?
Yeah, this question was pre-seed. Yeah. My question was more general. For startups in general, what should we be focusing on now? But let's answer this one that came in.
Pre-seed guy, my advice to you is you're kind of fucked, right? You're not raising money from new investors right now. Like find some other way to launch your business for now. For slightly later stage guys who have prior investors, if they are not running for cover, they're not angels that are suddenly like cowering under their beds, your best bet if you need money is an insider bridge round, right? If they really believe in you and they believe your long-term prospects are still good, and they believe that you just need to get through the next 6 months, then you can put together an insider round. It may not be pretty, but that's your best bet if you need it.
Jeffrey?
Our focus is primarily on Series A. The advice that I would give pre-seed people now, specifically because of the type of money that I think those deals attract, is to be sensitive to the environment. Be sensitive to the environment that we're in. Try not to use words like opportunistic and leveraging a crisis, because when I hear that, interestingly enough, the amount of emails I've gotten and inbound deal flow has spiked, and we already see an overwhelming amount of deal flow. And it saddens me, because the narrative that some of these entrepreneurs or would-be entrepreneurs are trying to leverage, it feels craven to me. And I suppose we're just not sharp-elbowed enough to look at things through that lens. That's just not the way that I was raised personally, and that's not the ethos that we embody as a firm. So I would say, again, underline, be thoughtful. Try to be thoughtful, because if you have something that is good, if you have something that you think there's a market for, there will be, I slightly disagree with my friend Andrew. I think that you will be able to find capital if there's real merit. I think the bar has been raised. and certainly in the Series A world. But the Series A world is different. You already have a more mature company coming out of earlier rounds. Where KP, if I'm not mistaken, you focus on seed. Is that accurate?
Yep.
Right. So if a company has already gone through a firm and like KP's and has been able to course correct with the advice of the people on their capital stack, then even in this environment, the best ideas should be able to find funding. But for pre-seed, I think thoughtfulness will go a long way.
So just to be clear, I'm thinking in the next month or two, longer term, I agree with you. Next month, even an A-round company that's doing well, I think is going to have trouble getting people to engage. I do want to underline something that you said, Jeff, because it's very, very critical, right? If a company, regardless of stage, is pitching me and the tone is, kind of profiteering, tone deaf as to what people are going through, then I can only imagine it's going to be equally bad when they try to pitch customers. So that's a bad indicator for me. I will see the world that way because that's my nature, but show me that you have some understanding of the environment you're in and you know how to present yourself in a way that doesn't come across like that.
KP, I'll give you the last word.
Yeah, so I think, to my point, Adult Swim, right? Like the amateurs are out of the pool now. So I think it gets back to fundamentals. I think you have to be succinct in what your model is. I think you need to not build a model that's you need to explain to me how you're going to get to your seed round, how your seed round is going to get to your Series A, like what is the math and the details. And that really all you really need is, so in full disclosure, I've never raised venture capital as an entrepreneur. I always bootstrapped. Venture capital is the most expensive capital on the planet. Like if you can avoid it, you should avoid it. That's the reality. So I think for me, it's always been, how am I going to get to that next milestone in a detailed way? Like show me in a detailed way what that milestone is, how you believe you're going to get there. We know it's all fiction, but show me how you believe you're going to get there. And if you hit that milestone, why is it meaningful? Why is it financially meaningful? And I think even entrepreneurs starting to shift and understand, like you have to put the investor's hat on. I had a startup that my little Calendly link, he's like trying to tell me like, oh, I only need to raise $200,000 and I can do this, this, and this. And I was like, I give you $200,000. When am I getting my money back and how much am I getting back? Tell me that. He could not answer that question, right? He kept talking to me about user adoption and God knows what else, right? And so I think you have to get in as an entrepreneur. It only is your time and energy to get yourself into the weeds and details. And the weeds and details are what amateurs kind of shy away from. They go, oh yeah, just send me a pitch deck. No, I don't care about your pitch deck. In fact, I'm suspicious. Really beautiful pitch decks, I'm very suspicious of. They're generally lipstick on a pig. So I want to understand the details. And I think this is a great time for entrepreneurs to work through the details. We agree, right? They're wrong, right? That's not how life is going to pan out. But they've all been taught, like, don't worry about the details. Just go to fucking Techstars and pitch something and they give you money, right? That's what they think. I think it's a time for people to really retrench into the fundamentals, do the deep thinking, do the deep work, and keep focusing, like just chopping away on your focus and get into those detail, because I love having those detailed conversations. And I think that's what's important. I think that's where you should be spending your time. To Andrew's point, it's really hard to even have a conversation about funding right now. It's just a tough conversation to have. So this is a great time to do the work and do the detailed work that apparently was not important a year ago.
Thanks, KP. So some key takeaways: empathy, details, fundamentals, and no pretty pitch decks. So with that, I'm going to say thanks to all three of you guys. This has been a fantastic conversation. I hope that we'll get to do it again. We had thousands of people logged in for this, so I know that there was a lot of buzz out in the industry. And so I appreciate your joining us on this CREtech talk event. And just to let everybody know, for more information and perspectives during this time of uncertainty, this is part of an ongoing series, and you can get more information at CREtech.com. And I'll say thanks to everybody, and we'll see all of you again soon.
Thanks
All right,
for
thanks,
having
Steve.
us.
See you.
Thank you.